Okay, folks, it's time. Welcome, welcome. I saw a lot of familiar names on the roster, but I don't see any of your faces. I couldn't even recognize you if I saw. No, so that's the problem with masks. But how many of you were in my corporate finance class? It's everybody. So you know the torture that's coming, right? So get your emails cleaned up because a lot of emails are going to come in over the next 115 days. But in case you're in the wrong class, let's make sure you are in the right class. This is valuation. Okay? Before I start in the class and talk a little bit about both what this class covers and how it might be different from what the corporate finance class was, I'll give you a little bit of history for this class. I came to NYU in 1986 and was hired as an assistant professor. And the first class they gave me to teach was a class called security analysis. For those of you not familiar with this class, it's a class with a very long and hoary tradition. It was a class that was started in the 1950s at Columbia University by a man called Ben Graham. You might have heard of him. And if you haven't heard of Ben, you've heard of his most famous student, of course, it was Warren Buffett. This is a class with a long and illustrious tradition. They hand me the class to teach. I take one look at the class and said, I don't want to teach this class. Not a great attitude for an assistant professor to take. But the head of my department was a good guy. He said, no, why? And I said, it's the most boring class ever. Because by 1986, it was showing its age. It was 4 weeks on stocks with, I think, a session on valuation, 3 weeks on bonds, 1 week on futures, 1 week on options, and 5 weeks on institutional detail. Like what? There was an entire session on listing requirements for the New York Stock Exchange. Teaching was so easy in the days before Wikipedia. You could actually come in and list out the requirements. People took everything down. They thought you were a genius and walked out of the room. Today, if I tried that, you'd be checking Wikipedia while I was talking. Said, I can see it right here. So he said, what would you like to teach instead? I said, I'd like to teach a valuation class. I still remember what he said. He said, don't do it. There isn't enough stuff in valuation to fill a class. And you know what? In 1986, he was absolutely right. There wasn't enough stuff in valuation to fill a class. There were no books on valuation unless you wanted to go back to Security Analysis by Ben Graham. You know when that book was written? Anybody? First edition Security Analysis? 1934. reflects a very different time, right? When stocks were like bonds, and basically the book reflects that. There were no books on valuation. There was no literature on valuation. There were none of the alphabet soup of credentials now you have for valuation, right? Like CFA, none of that stuff is around. But I really, really, really wanted to teach this class. And I discovered very early in my academic life that if you want to get anything done at a university, the best way to do it is to do it subversively. Because if you try to get official permission, you know what would happen, right? A committee would be formed. You guys have experiences with committees being formed? You know what happens after they get formed? They meet and they meet and they meet. They forget what they're meeting about, but they keep meeting. They have baby committees that they call subcommittees and subcommittees. And by the time they got back to me and said I could teach the class, I'd be too old to do it. So I said, I'll teach a security analysis class. And I walked in and taught a valuation class. They have no idea what I do. Remember, this was 1986. There were no cameras in the room. You closed the door. You could teach cooking for 15 weeks. And if you gave everybody A's, nobody's complaining. You know how long it took them to catch on? This is 1986. I teach my first valuation class. In 2008, I get a call from the dean's office. We hear you're teaching a valuation class. I said, I've been doing it for 22 years. They said, we don't see it listed anywhere in the course schedule. I said, that's very easy to explain. It's because I've been hijacking all these other classes you've been giving me and teaching valuation. Instead, for a decade, you asked me to teach an equity instruments and markets class. I have zero interest in instruments, none in markets, and I'm not that fascinated with equity. So you take all three out, what are you left with? And I can't talk 15 weeks about and, so I said, teach valuation instead. They said, that's not right. We should call it valuation. I said, I agree. So if you look at the NYU course listings, you see valuation show up for the first time in fall of 2008. But this spring, when I'm teaching two sections of valuation, one to you and one to the undergraduates, it'll be my 55th and 56th semester teaching valuation. And I'm going to say something about this class. It's going to encapsulate how I think about the class and the way you're going to see this class start. Everything I know about valuation, I've learned in the course of teaching this class. Let me repeat that again. Everything I know about valuation, I've learned in the course of teaching this class. I didn't know it when I walked in. I'll give you a few examples of how my thinking has changed as I've taught this class. 1 year into teaching this class, fall of 1987, I remember the day, October 19th. It was a Monday. At that time, the graduate school was downtown, right next to the American Stock Exchange. I finished teaching the class. I come back to my office. It's on the 9th floor. I look out on Rector Street, and everybody in the stock exchange is out on the street. So what happened? Fire alarm went off. You know what happened on October 19th of 1987? What happened on October 19th of 1987? The S&P 500 was down. Guess how much in one day? 22%. Think of what that would look like in today's market. A 22% drop in the S&P 500. The Dow would be like, and the Dow would be like 6,000.
Here for a while, or are you about to head out? Stanley's outside.
Yeah.
Guys,
Are you going to leave?
Yes. Yeah.
you got to mute yourself, please.
Are you going to bring?
You want-
Brian, mute yourself. Man. It's a one-day crash, 22%. It was a Monday. I had to come back in front of my class on Wednesday. Guess what the first question I was asked was? How, with valuation tools, can you explain at 22%? This isn't one stock, the entire market. How can a market drop 22% in one day? What can happen in one day? And I'll be honest, I didn't have the answer, but I tried. I tried thinking about what it is that causes entire markets to drop by 5 or 10% in short periods. And you know what? That thinking stood me in good stead as I went through other crashes. And so when I think about markets in crisis now, whether it's 2008 or between February and March of 2020, and the market was down 35%, I still go back to the way I started thinking about market corrections and market crises in 1987. Then you move forward a decade, 1990s, you saw a new type of company entering public markets. What type of company? Companies with small revenues, big operating losses, lots of potential. What do those companies do before the 1990s? They've been around before the 90s, right? But prior to the 90s, if you're a company with small revenues, big operating loss, and lots of potential, what happened? You stayed private. Venture capitalists invested in you. But in the 1990s, companies decided that they were going to enter public markets. Usually they had a .com at the end of their names. I still remember the day in 1997. And by that time, we were in this building. It's in this classroom. Somebody asked, can you value this company called Amazon.com? 1997. You know what Amazon.com was doing? It was an online book retailer. That's all they sold is books. And stupidly, I said, I don't see why not. In 1997, I valued Amazon for the first time in class. I valued Amazon every year since. So you're going to see some of my updated valuations. But when I first tried to value Amazon, I looked in the literature. There was nothing about how to value companies with big operating losses, small revenues, and lots of potential. Nothing. I still tell people everything I know about valuing young companies, I learned in the process of valuing Amazon in 1997. So when you see me value Airbnb or Paytm, you still see the residue of that Amazon valuation. Then you get to 2008 and you have a market crash, right? Precipitated by banks behaving badly. And again, the question comes up, why when banks behave badly, does the rest of the world have to bear the cost? And again, in valuation, we have to talk about why when some companies, especially banks, do stupid things, everybody else is going to see their value impacted. And then you get to the last decade. And you saw the rise of what I call the numbers company. We give a few examples. Great companies, one of the great companies the last decade was Facebook. What's the most impressive number about Facebook? Anybody want to try? What's the most impressive number? Yep. Number of users, right? Its revenues are not that impressive. There are lots of companies that deliver a lot more in revenues. Its margins are really good, but Philip Morris has higher margins. The most impressive number about Facebook is 2.5 billion users in the Facebook ecosystem. And by the ecosystem, I include Facebook, Instagram, WhatsApp. 2.5, think about that. 1 out of every 2 adults walking on the face of the earth is in the Facebook ecosystem. You're saying, so what? 2017, again in the middle of a class, somebody says, can you value a Netflix subscriber or a Facebook user? Notice how the question was phrased. It's not, can you value Netflix, but can you value a Netflix subscriber, an Uber rider, a Facebook user? And again, stupidly, I should learn by now. I said, I don't see why not. And in class over the next 2 weeks, we developed an infrastructure for valuing a subscriber, a user, a customer. And I valued a Netflix subscriber, an Uber rider, an Amazon Prime member. And when people talk about the values of platforms now, I can now talk about why are some platforms more valuable than others? Because I have the infrastructure coming from having to deal with that question. And then you get to 2020. March 6th of 2020, I was teaching this class in this room. At the end of the day, I got an email from NYU saying, leave now. And I was ready to leave. I live in California, so I'm leaving. So I left. And they said in 4 weeks, we'll be back. There's this virus coming, floating around. 4 to 6 weeks, we'll be back. Yeah, 4 to 6 weeks, my foot. But the class continued. And if you remember what happened between February 14th of 2020 and March 23rd of 2020, markets were in full-fledged collapse. Equities in the US were down about 35%. Across the globe, you saw markets they were in retreat. It's like on March 23rd of 2020, we'd absolutely hit bottom. If you get a chance, go back and read the journal or any financial press or listen to CNBC from March 23rd of 2020. You know what you were hearing? The end is near, head for the hills. March 23rd, we were actually in the middle of a class. So somebody in class said, can you still value companies when the entire global economy is shut down? I said, why not? And we valued Boeing on March 23rd of 2020. The YouTube video that I used to value Boeing is still online. But here you have a company in the middle of the storm, right? A company that sells aircraft. Airlines are not flying. But it's a pity to let a crisis go to waste, because some of your best learning can come when you're most unsettled. So one of the things I chose to do between February 2020 and November of 2020 is every 2 or 3 weeks, I chronicled something I was uncomfortable with, something I couldn't explain, and tried to write about this is where I am, and this is what I'm thinking through. By the end of the November 2020, I had a series of 14 posts around the virus and how it was playing out. Because it was fascinating to see money leave the market and then come back so quickly that by September, stocks were back to where they were before the crisis, and by November, they're 10% higher. Everything that happens in markets is an opportunity to go back and say, hey, maybe we can do things better. Here's the thing about valuation, it's never boring. There's always interesting things happening. But remember, interesting is a Chinese curse as well. May you live in interesting times. Because interesting times can often mean meltdowns in markets and trying to explain things. And I have a feeling that the next 4 months are going to deliver their own set of surprises. And who knows, maybe there'll be another opportunity to go back and look at things the way we've done and say, maybe we can do things differently. So if nothing else, here's what I hope to do during this class. It's like this collection of experiences from the last 36 years and see if we can frame a way of thinking about valuation that's flexible enough that we can deal with the next surprise. So let's start the process rolling here. You guys have to read the caption, I'm sorry. So if the captioning is off, you can tell me. With a little bit of logistical details. As you well know, you're not allowed to have physical office hours this semester yet. NYU has said you've got to do office hours online. So I will set up Zoom links for office hours. I had to play with the times a little bit because there are at least 10 or 15 people who are trapped overseas who can't make it back. And some of them are in Asia. So if I do office hours in the middle of the day, like 12 to 1, which was my original plan, that's going to be like 3 o'clock in the morning. So let me work on getting office hours so people have it, and I will send the Zoom links for my office hours. Okay? And normally I would say, no, I'm fair game if you find me, but in this environment, it's going to be very difficult for you to find me physically. So you got to find me online, and I'm easy to find online. There are 2 TAs for the class. Okay? Kushal and Prachi both took the class last spring. They know this class inside out. They've gone through every exercise in this class. They will be setting up their own office hours and review sessions every week for the next 15. And the review sessions are to work through practice problems, because I'm not going to work through practice problems in class. It's a waste. It's not a good use of my time, and it's not a good use of your time for me to go through step by step. It's not, the mechanics are the easiest part of this class, and they will take care of the mechanics if you feel uncomfortable with Now, I don't get that mechanical step of how you converted leases to debt. The review sessions will go through the actual examples. So here's what we're going to do. Okay? Don't read this page ahead of me. I want you to kind of hold off on this because I'm going to start with a series of questions about valuation and about yourselves to kind of lay out what I call the broad philosophical foundations for valuation. That sounds like a strange word to use, right? Valuation is all about numbers. What's philosophy got to do with it? I think the philosophical foundations are far more critical than the details you can learn about valuation. Here's the first one. Okay, so as I said, don't look at my answer. One of the most common questions I get asked is valuation an art or a science? Think about it for a moment. Let's break it up. Is valuation a science? If you listen to the accounting rule writers, they seem to think it is a science, right? If they write enough rules, it's going to become a science. It's delusional. And here's why. Let's think of what makes for a pure science. There's only one pure science, mathematics. Mathematicians are convinced that the rest of us are imposters. Let's think about what it is about mathematics that makes it a science. Anybody want to hazard a guess as to what is it about mathematics that makes it a science?
Replicability.
Replicability. That's a good point, but it's not just it's absolute replicability, right? Because you can replicate. In psychology, for instance, people replicate. You get answers, but they're all over the place. In mathematics, it's absolute. 2 + 3 is 5. It's not a trick question. Right hand, left hand, North Pole, South Pole, whatever. I could use a calculator, I could use a computer. There's no maybe in mathematics. It's either right or it's wrong. In mathematics, if you get the inputs right, you get the output right. So if you use that basis for a science, physics is mostly a science, right? The laws of gravity are the laws of gravity. If we all got together on the 9th floor of the building and we jumped out at the same time, we don't fall in the order of our IQs or where we are in the hierarchy, we just fall. The laws of physics apply to all of us. But if you define a science based upon if I get the inputs right, the output will be right, there is zero chance that valuation can ever be a science, right? Think about it. I give you a company to value. You have every tool at your disposal. You've learned everything to know about valuation. You have access to every data item out there. Your valuation is still going to be wrong and sometimes horribly wrong. You know why? Very simple reason, you're not God. There are things that can happen in the future that no matter what tools you bring and what data you have, you cannot predict. Imagine valuing Marriott in 2019. You did everything right, but you know what you missed? What would have gotten your valuation completely off the track? That a stupid virus would land up in February and completely shut the hotel business down for almost an entire year. You can do everything right and be completely wrong. And you got to be okay with it. Valuation is not a science. So it must be an art, right? Let's again take a typical art, paintings, not painting your house, but the paintings in museums. Let's think of what makes for a great artist. I still remember taking my oldest son, he's now 32, and he was 8 years old, to the Met for a Picasso exhibit. Now, he lasted about 30 minutes. That's how long 8-year-olds last in museums anyway. We come out and I ask him, Ryan, what do you think about that? He said, I wasn't impressed, Dad. I said, what's a Picasso exhibit? He said, this guy can't get the nose in the right place. You notice this about Picasso's side of the head, the top of the head? It's almost like he was drugged or drunk, which given his history is probably both. But we've all decided Picasso's is special. The essence of an art to me is you cannot make great artists. You can teach good art, but you can't make for great art. It cannot be taught. I hope valuation is not an art. I wasted 36 years of my life trying to teach something that cannot be taught. So it's not a science. It's not an art. What the heck is it? I'll give you the word that I think best describes valuation. It's a craft. And I'll give you the discipline that I think is closest to valuation. It's cooking. What do you need to do to become a good cook? You could watch the Food Network 16 hours a day, right? Chopped episode, Beat Bobby Flay, over and over. But I guess what, if that's all you do is watch TV, you're not going to be able to cook. If all you do is read cookbooks, you're not going to be able to cook. To learn cooking, you actually have to go to that room in your apartment or house called the kitchen. You've been avoiding it with takeout food for the last, I don't know how many months. And you got to start cooking. And when you start cooking, what happens? Disaster, fire alarms go off. I still remember the first time I scrambled eggs. Nobody told me I was supposed to spray the damn pan. The eggs looked really good, but I couldn't get them off the pan. Pan and eggs went into the trash, but I learned a very important lesson about scrambling eggs. Spray the damn pan first. You learn cooking by cooking. You learn valuation by doing. This is really bad news. You know why? Because you're going to watch me for 26 sessions talk about valuation. But this is not where you're going to learn valuation. You're going to learn valuation, but actually getting your hands dirty and valuing companies. And I'm going to try to make it as easy as possible for you to be able to do that. But a lot of it is going to be up to you. I'm going to basically say you don't have to do this for the class. But if you really want to master valuation, I want you to give it your best shot. So you know what you're going to get tomorrow and every Tuesday for the rest of the semester? You're going to get what I call the evaluation of the week. And what I'm going to do is I'm going to take a company and I'm going to value it, and I'm going to create a spreadsheet and a story, and I'm going to put it online, and then I'm going to encourage you to try to value that company. I'll give you a preview. Tomorrow I'm going to post my valuation of Tesla from November of 2021. I'm going to also put a link to the blog post I wrote so you can see not just the valuation in the Excel spreadsheet, but what I did to value the company. It's a do-it-yourself valuation of Tesla, where I lead you through the process of, hey, tell me what you think about Tesla, because the reality is this is a company where there's an incredible room for disagreement. Is it an electric car company or is it an energy company? What's going to happen to the automobile business? And at each step, I'm going to make you pick, and then you're going to come up with the value. And guess what? Your value is going to be different from mine, even though we look at the same facts, because you made different choices about the company. And I'm going to ask you to enter that value into a Google shared spreadsheet if you do the valuation. Think of it as a crowd valuation of Tesla. Now, your first reaction might be, I've never valued a company before, which shouldn't be the case if you took corporate finance, but if you didn't. But you know what? Do what you feel comfortable doing. So if you've never valued a company, here's what you're going to do. You're going to take my valuation, leave all the inputs unchanged, and change just the third decimal point on the risk-free rate. And guess what you're going to find? Your value is very close to mine. Don't think of this as a good thing. It means that you're not yet comfortable disagreeing. That's perfectly okay. Next week, I haven't decided yet. Maybe I'll value Peloton. We talk about a company that zoomed with the virus and seems to have crashed. I bought Peloton yesterday. I'd love to see what the crowd valuation of Peloton looks like, because I think there's an interesting story about the company, but there are also things that the company has to overcome. The week after that, I might value GE. Why? Because I want to value a dead man walking. This company's best, forget about the best days are behind it. Its worst days are even behind it. This is just, I mean, there's the story you're going to tell is like a horror story. You know how that teenager pauses outside the door to the basement and you're screaming, don't go down there in a horror movie? G's at the door. It's opening the door. Here's the chainsaws down there. It says, let me go check out what's going on down there. The week after that, I might value PZ Cousins, Nigeria. Say, I've never heard of it. Good. It's an appliance company in Nigeria. And my point is I'm going to value 15 very different companies over the next 15 weeks. For the same reason, said you have to cook to master cooking, but if all you cook is pasta week after week after week, you're going to get really good at cooking pasta. But then if I ask you to make bibimbap, you say, I have no idea what that is. I want you to get comfortable valuing different kinds of companies, young and old, distressed and growth, emerging market and developed market. But I'll tell you up front, this is completely optional. You can do fine on this class without ever doing a valuation of the week. And you might get too busy, it might not be. But if you do it, I think you will learn a lot more about valuation than anything you do preparing for this class. The essence of a craft, though, is you will never, ever master it. Now, there was this show on PBS called This Old House. And there was this master carpenter called Norm on it. And I still remember what he'd say, I keep learning new things every week. And this guy's a master carpenter. Same thing is true in valuation. You will constantly find new things you learn that will make you better at the craft. Never shut the door and say, I'm done. Because there's still so much more to learn. Second, I have this fixation that's going to get really old on you. But I'll tell you up front what the fixation is about. It's about two words in investing we use interchangeably that we should not. One is the word value. The other is the word price. Investment banks use the two words, consultants use the two words interchangeably, but they should never. Let's talk about the difference between the two words and where they come from and why we shouldn't use them interchangeably. We know what drives the value of an asset. We know what drives the value of a business. You know what drives it? Cash flows, growth, and risk. We can dance around this as much as you want. You can build a discounted cash flow model, but the essence of value is you have to have a business model. I estimate the cash flows. I'm not saying it's going to be precise, but value comes from cash flows, growth, and risk. To value a company, then you got to understand the business it's in and build in those cash flows. That's what we're going to spend 2/3 of this class on. But 90% of people out there, when they put a number on a company, are not valuing the company, they're pricing the company. You're saying, what's the difference in pricing? Pricing is driven by demand and supply. Of course, cash flows, growth, and risk can affect demand and supply, but demand and supply are also affected by mood and momentum, and sometimes revenge. You know what I'm talking about? A year ago, there was this episode centered around a company called GameStop. Remember what happened? For those of you who want to step back, if you think about GameStop as a business, many of you are, I'm sure have visited a GameStop store in a mall, right? You walk in, it's a brick and mortar company that sold games. And as you know, brick and mortar retail in the US has been on this doomsday walk for the last 20 years. And GameStop is no exception. So for the last 3 or 4 years, GameStop's business model has been imploding, and people expected to not just get in trouble, but essentially go kaput. So in 2019 and 2020, a lot of people started selling short on GameStop. Selling short is basically borrow shares, sell the shares, hoping that the price drops and you can cover. By the start of 2021, it looked like GameStop was on a pathway to zero. The stock had dropped like 15, 14 people. And then something almost miraculous happened. A bunch of investors gathered together on Reddit in this group called Wall Street Bets. And they decided they were going to buy GameStop and push the price up. It was precipitated by a guy who calls himself Roaring Kitty. He works for an insurance company in Massachusetts. He'd done a valuation, which he claimed he got the spreadsheet from my website. So I have no idea whether this is true or not. So his original, so basically the DCF in the middle of 2020, but by 2021, he'd convinced enough people in Wall Street Bets to buy the stock. And did they buy it? You know what they pushed the stock price to? Briefly, it hit $450 per share. Now, there is no business model on the face of this earth that you can come up with for GameStop that explains 450. You can tell me it's worth 50, maybe 60, but 450. So I decided to visit Wall Street Bets and started reading the comments because I wanted to see what's the story they're telling about this company that explains the 450. You know, the overriding reason people were buying was they wanted to take revenge on the hedge funds. That was it. In fact, you looked at post after post. There was no talk about cash flows or growth or risk or business models. A few of them threw in the fact that the guy who founded Chewy was now, a stockholder, that he might change it, but what are you going to do? Sell games to dogs? I don't know what the mix is, but maybe he'd figure out an online platform. But the overriding reason pushing the price up was we want to get revenge. If you get a chance to visit my blog last year, I called it the first crowd squeeze in history. Because usually when you sell short, there's a risk always of getting squeezed. Squeeze basically means somebody comes and buys up all the shares in your company. So when you try to buy the shares to return them, there are no shares out there. Historically, short squeezes have been engineered by really wealthy, vindictive men. I don't think there were any women on the list that I looked at. No. Who want to essentially show the other side that they're more powerful. But this squeeze was not engineered by a single investor. It was engineered by thousands of investors. And in a sense, it reflects the times we live in, right? We live in social media, so the crowd can gather on a social media site and buy it. It's changed the short selling business forever. The old days when you sold short on a stock, you got out there and you told the world how overvalued a stock was. Now you'd be crazy to do it, because if you put your head up and say, I'm selling short and you're a big name, it's almost like you're encouraging people to gather as a crowd and come after you. But my point is a simple one, which is when you think about pricing, pricing is not just driven by fundamentals, it's driven by human emotions. And we've known this for a long time in finance, right? In fact, there's an area of finance built precisely to try to explain why human beings sometimes do things that don't make sense from an economic standpoint. It's called behavioral finance. Price is driven by demand and supply, and all those human emotions that can go to demand and supply. So here's the bottom line. The value process, cash flows, growth, and risk delivers a number. The pricing process based on demand and supply delivers a number. Will the two numbers be the same? Well, let me rephrase that. What do you have to believe about markets for the two numbers to be the same? You have to believe markets are efficient. If you believe markets are efficient, you might say, look, price can be different from value, but it can't be too different. Do I believe markets are efficient? If I did, why would I be teaching this class? I mean, let's be real. If markets are efficient, what's Peloton's value? Go check it out online. What is it trading at, right? In an efficient market, the best estimate of value is the market price. So the very fact that you're sitting in this class is already an admission that you believe that the value process and the pricing process can deliver different numbers for the same company at the same point in time. And here's the reason I draw a distinction between the two. Some of you are going to end up working in what you think is valuation. Let's take an example. Let's say you get hired by Morgan Stanley for their IPO team. What's your job? I have a young company. I want to go public. I come to Morgan Stanley, right? What's your mission? What do you have to do? Value my company or price my company? Your job is a pricing job. It's not tell me, oh, you know what, young companies losing money are worth nothing, because if people are paying $100 million or $1 billion for my type of company, your job is to deliver that price. Banking is almost all pricing all the time. And you know how we price companies and assets? We don't come up with cash flows, growth, and risk. We try to look at what other people are paying for similar companies. Is this starting to look familiar? You open up an equity research report. How do analysts decide whether something is cheap or expensive? They come up with a standardized price, which is what a multiple is, PE ratio, EV to EBITDA. They compare to 15 other companies, and they say there's nothing wrong with that, but don't ever use the word value anywhere in that report because you haven't valued the company, you priced the company. One reason I'm going to emphasize this difference is so much of the frustration and valuation comes from misunderstanding the two. Did the value of Netflix drop 20% 2 weeks ago? I have no idea. The price dropped, but the only way to address the question of whether the value dropped is to actually do an intrinsic valuation. Was Peloton actually worth 10 times more than it is today a year and a half ago at its peak? Well, the price was 10 times higher. The value, we have no idea. Pricing and value are different processes, and we need to treat them differently. I told you 2/3 of this class is going to be about valuing companies. You know the other third of the class is? It's about pricing companies. Why? Because most of you are going to end up in jobs where your job is pricing. It requires a different set of skills, a different way of thinking about numbers, and the discipline you need the most is statistics. It's not finance. Because what are we trying to do with pricing? We're trying to make sense of how investors are pricing hundreds of companies and trying to attach a pricing to us. It's a classic statistical problem. So in pricing, you're going to start seeing me use statistics a lot more than finance because we now have data. We need to figure out ways of making sense of that data. Any questions on value versus price? So what I'd like you to do is as you read the journal or read the financial news, you'll see people using the word value. And you have to stop them because in a sense, value and price are very different things. And you have to think about, are you really valuing the company or pricing the company? And understanding the difference is key to kind of making sense of why markets do what they do. Now, what are we going to value? Just about anything. Of course, we're going to value companies. If you start at the premise, value of an asset is the present value of the expected cash flows, we're going to start with investment to cash flows. I'm going to value young companies, old companies. I'm also going to look at valuation through different perspectives. You're saying, why would value be different depending on who's looking at the company? An individual owner looking at a company he or she owns can attach a very different value to the company than a private equity investor looking at that company. And a private equity investor can attach a different value than a public investor in the company. We're going to draw a contrast between different types of investors. We're also going to look at different, companies, not just in developed markets, but in emerging markets. So essentially, we're going to value pretty much any type of company. But we're not going to stop there because we're also going to look at pricing these companies. What would you do differently? And with pricing, we're going to expand and look at investments that don't have cash flows. I'll give you a preview. The most asked question I've had in the last 14 years is Bitcoin undervalued, overvalued? You know what the answer to the question is? A currency cannot be valued. A collectible cannot be valued. It can be priced. So we're going to talk about how do you price gold? How do you price a collectible? How do you price a baseball card? How do you price a Picasso? How do you price Bitcoin? So we're going to expand pricing to pretty much cover investments you can't value. And finally, if there's anything that's new and different about this class than if I taught this 30 years ago, it's we now have access to tools that we can use to value companies we would have given up on a few decades ago. I don't want to be mysterious, but the tools we're using are option pricing tools. You're saying, why are we using option pricing? We're not going to use option pricing to value options. That's a different class. Frankly, I have zero interest in it. We're going to use option pricing tools to value certain kinds of companies that otherwise are out of our reach. Like what? A natural resource company with reserves that are not viable today. An oil company. Lots of reserves, but today, at today's prices, they're not viable. You might still pay for the company because there's optionality. What's the optionality? If oil prices go up, those reserves could become valuable. What if I came to you with a young pharmaceutical company in 2018 that's working on a type of vaccine that's never been worked on before? You know who I'm talking about, right? Moderna in 2018 had no revenues and big operating losses, but this promising technology it was working on, we didn't know how much promise. At that time, nobody thought that the entire world might use it, but you were essentially buying an option. We're going to talk about applying option pricing in places where it makes sense. But we're also going to talk about how some people are overreaching. I see people using the options argument to put big premiums on companies with user platforms. Why are you paying for the user platform? I don't know, but they have lots of users. It's very lazy. We have to talk about when it is that option arguments make sense to attach a premium. I told you, valuation is a craft, and there are things I've learned along the way. So I'm going to ask you a question to which there is no right answer. So don't look at your neighbor. But this is a question where I want you to look inward. If I asked you to describe yourself as a person, would you more naturally describe yourself as a storyteller or a number cruncher? I think I asked the same question in corporate finance. Let's see if you've changed your mind. Which comes more easily to you, telling stories or working with numbers? Had a chance to think? You're saying, how would I know? You've known for a long time. You probably knew when you were 12 years old. You know how you knew? You dreaded the English class. You loved the algebra class. And you listened, right? The rest of your life was kind of laid out for you because you loved the algebra class. You took quant classes more in high school. Then you ended up with a quant degree and probably a job working with numbers, a banker, an accountant, an actuary, an engineer, a mathematician, a scientist. And you hung out with other people who are also numbers people. Conversely, if you loved the literature class, you kind of steered towards those literature classes, and you maybe became a history major at Yale, and then you graduated and you got a job and you discovered that even Yale history majors don't get paid very much. So you came back for your MBA. Yeah. But my point is we kind of pick our strong side and then we kind of tailor our choices based on that. And if you come into a valuation class, you probably come in with at least the perception that the numbers people have an advantage, right? Because when you think about valuation, what do most of you think of? Excel spreadsheets and lots of numbers. And I'll be quite honest, that's what I used to think. When I first started teaching valuation, I taught it like a numbers person did, which means when in doubt, put up an equation. If you're still doubtful, put up a second equation. If you're still doubtful, make them simultaneous equations, solve them. It'll do nothing for the world, but in a sense, you feel more comfortable. I tell people, when you're a numbers person, when in doubt, you know what you do? You add decimals. It makes you feel, oh, that looks more precise. But I discovered about 6 years into teaching this class, it took me a while, that I had a problem. You know what the problem was? I could value just about anything, but I had no faith. I'm going to come back and talk about that word faith a little bit more. Saying, what's faith got to do with it? It's got everything to do with it. Because when you value a company, let's say Peloton, you value a company at 40, stock's trading at 25, which is the price I bought it at. How does faith enter? You value it at 40, the stock's trading at 25. You need faith in that $40 value and faith that the price will. I discovered I had no faith. Why? Because I knew how easily I could move the numbers to get a different number. And that's when I realized that if all I have are numbers on a spreadsheet, I don't have a valuation, I just have numbers on a spreadsheet. I have a financial model. It's amazing how much evaluation has devolved into financial modeling. You've taken the training the street classes. Basically, they teach you how to become an Excel ninja. You hit these combination keys. Every alternate row turns different color. Amazing. That'll improve my valuation dramatically right there. But it's become almost entirely financial modeling. So here's what I knew I needed to do. I needed to find a story that essentially kept my numbers together. So I couldn't just change one number because I was changing my story. A good valuation is a bridge between stories and numbers. So what does that even mean? If I show you the valuation of Tesla, and you're going to see it tomorrow, and you see 600 billion in revenues in year 10, I better tell a really big story about Tesla to explain the 600 billion revenues in year 10, right? You know why? What's the largest automobile company in the world right now? You know, between Toyota and Volkswagen, they're pretty close. You know how much they have as revenues? A little less than 300 billion. So when I show revenues of 600 billion for Tesla in year 10, I'm already telling you a story where 10 years from now, the bulk of the automobile market is going to be electric cars. I didn't have to fill in the details. It has to be. And Tesla has to have a dominant market share of that market. And I need to be explicit about that story. You know why? Because I want you to push back. Maybe your reaction might be, that's not going to happen. Daimler and Ford and GM are going to catch up. Or people are not going to buy as many electric cars as you thought. But every number in my valuation has to have a story attached to it. So when I say margins for Tesla are going to be 22% 10 years from now, I have to have a story that explains how an automobile company is going to have 22% margins. You know why that's a reach? Typically, automobile companies have single-digit margins. It costs too much to make a car for you to make 15, 20, 25% margins. So implicitly, I'm telling a story where Tesla is going to be able to earn higher margins than a typical automobile company, but it's the onus is on me. I come up with the number, I have to give a story that backs that number. So if you're a number cruncher, every number in evaluation, you have to figure out a way to come up with a story that explains it. The story's got to hang together. You can't just explain each line item because collectively you're telling a story. If you're a story person, though, you love telling stories. You're a VC, you're a founder. You know what I'm going to push you on? When you tell me your company has a great brand name, we say, where in the numbers are you going to show that? You tell me it's got amazing management. Where in the numbers are you going to show that? You got a very loyal workforce. Where in the numbers are you going to show that? And trust me, each of those can be shown in a number. But every story you tell about a company has to have a number that goes with it. That's what I want you to work on. I'm still working on it. As I said, when I started this process, I was a number cruncher. I had to teach myself storytelling. And it wasn't easy. The first time I did it was like pulling teeth. Because to me, telling a story was an admission of weakness because it seemed so imprecise. I had to learn to tell stories. I'm still more naturally a number cruncher, but I've become better as a storyteller. And what I will do during at least one of the sessions, I'll take you through the process of telling a story and connecting it to numbers. But you'll have to figure out your own way of working on your weak side. You know what I mean by a weak side? If you're a numbers person, I want you to work on your storytelling. If you're a story person, I want you to get comfortable enough with numbers that you can talk about margins and not feel like you're giving ground. Here's my end game. By the end of this class, if you're a number cruncher, I hope you develop enough faith in your imagination that you become an imaginative number cruncher. If you're a storyteller, I hope by the end of this class, you get comfortable enough with numbers that you become a disciplined storyteller. And I'll tell you up front which group I'm going to have more trouble with because I have a history of trying this for 30 years now. Guess which group I always have more trouble with? Getting number crunchers to trust their imagination or storytellers to start to get comfortable with numbers. In my experience, you give me 100 history majors, I can teach them enough valuation they can value companies by next week. You give me 100 engineers, I am completely and totally screwed. Because you've spent an entire lifetime bludgeoning your imagination into the ground, right? It's a sign of weakness. You will face this psychologically when you value companies, because if you're a number cruncher, this imprecision in this process, the fact that there's no closure, is going to drive you crazy. You got to let it play out and get comfortable being wrong. Because I'll tell you, you're going to be wrong 100% of the time. You know what I mean by wrong 100% of the time? I've never valued a company where every single number comes in exactly as predicted. It would freak me out if it happened. It'd be like a Twilight Zone episode. You got to get okay being wrong and okay being imprecise. And that's more psychological than anything I'm going to tell you about doing it. So let's talk a little bit about this word faith. I told you to act on your valuations, you need faith. You need faith on two dimensions. Faith that your value is a reasonable estimate of value, not the right, because nobody knows whether it's right, but a reasonable estimate of value. And faith that the price will correct to the value. Because remember, if the price never corrects, Peloton stays at 25 and I'm still right about 40, I don't make any money if it doesn't come around. I need faith. You know why I use the word faith? What's the essence of faith? If you ask me to prove that this will happen, it's like asking your priest or your rabbi or, prove to me God exists. And if that priest or rabbi is not, a flim-flam artist, he or she's going to say, you know what, I can't prove it. The essence of faith is you just act without proof. And in a sense, in valuation, if you say, prove to me the price will adjust to value, my answer is, I can't prove it to you. You need to have faith. And let's face it, most people, including most people who claim to be value investors, have no faith. You know how this shows up? You go into a company and they use the word conviction. I have a lot of conviction. I'm going to buy 1 million shares of Peloton at 25. The next week, the stock drops to 21. It's like the market's knocking on your door and said, do you still have faith? I'd be lying if I didn't say the price moves against me, that my faith is being tested. But that's okay. I still remember when I was very young, my mother took me to see Mother Teresa give a talk. And I still remember what she said during the talk. She said, every morning I wake up and I question the existence of God. You know what? Mother Teresa can wake up every morning and question the existence of God. I can wake up every morning and question my valuation of Pelotons. Maybe I got it wrong. I find myself very uncomfortable with absolutes in investing. So when Kathy Wood gets out there and says, I think there's and she doesn't say, I think, I know there's a bubble in value stocks. Already my radar goes haywire and says there's something off here, because the history of markets is people who speak in absolutes don't have faith, they have dogma. And investing is full of the carcasses of people who bring dogma to the game. So during the course of this class, I will let you know when my faith is tested. So when Peloton hits 10, I'm not making a prediction and I'm still holding it. I'm going to get up and say, I'm feeling really, really uncomfortable now. In fact, I'm so uncomfortable, I'm selling. Faith is going to be tested, but faith is something that I can't endow. It's something that you work through. And for some of you, it might never come, in which case, you know what you should do? Either become a trader, in which case you don't need faith, you just need momentum, or buy index funds. And you know what? That's perfectly okay. You can live a completely happy life invested in index funds. You don't need to be this active investor that beats the market by 3% to have a happy life. So it's something you got to work through, and it comes just with playing the game over and over until you feel comfortable enough saying, I have faith. So here's the structure for the class. This session and the next, we're going to talk about the big picture valuation, the different ways you can put a number on a company. Then we're going to spend about 9 sessions kind of reviewing things you should have learned in corporate finance, but probably have forgotten in the summer since the class and the fall afterwards. Things like, how do we measure risk premiums? What are cash flows? So basically a review of the inputs into valuation. Then you're going to get really impatient while I'm doing this, because there isn't a single company I will value fully. I will take pieces of companies and talk about the cash flows to Cisco and the growth rate for HP. But I want to get the details nailed down first. And then once we do that, we can be off to the races. I'll value about 25 companies, very different companies from emerging market, developed market, young companies, old companies, applying those same inputs. And then we're going to move on to a pricing section. Remember I said pricing, you try to put a number on a company or an asset based on what other people are willing to pay for similar assets. We're going to talk about how do we put that into practice? How do we standardize prices? Why PE versus EV to EBITDA? And if you decide to go with PE, what are the things you need to control for? Let's get good at pricing. I think it's hubris to say I will never have to price something, because that might be a job. Then we're going to spend a session on what I call asset-based valuation. When would you need to use it? If you have to do a liquidation valuation. No point estimating cash flows. You got to sell things and say, what am I going to get? If you have to do a sum of the parts valuation, we value a company in pieces. We're also going to spend a session on private company valuation. Might seem like too little, but guess what? The mechanics we use to value public companies can be transposed to private companies, but there are estimation differences. How do you estimate the discount rate for a private company valuation? Be very different than how you estimate the discount rate for the same company that's public. So we're going to talk about the challenges of valuing private companies. And then we're going to spend about 3 sessions, kind of fleshing out this options argument. How do you value a natural resource company? How do you value a pharmaceutical company? How do you value a company with a patent that's not viable, a technology that's not viable? And then I'm going to spend 2 sessions kind of mopping up, or we're going to take what we've talked about in intrinsic valuation and apply it. One is in acquisitions. That's all you need, a session on acquisitions, because if you understand the mechanics of valuation, you can value a target company in an acquisition. But in acquisitions, you have 2 other words that bubble up to the surface: synergy and control. They're often the basis for these big premiums that get paid. But amazingly, people often don't seem to value them before they pay them. So I'm going to talk about, if you really wanted to value synergy, how do you do it? Let's face it, that's one of the stories behind the Microsoft acquisition of Activision, right? That they're going to find ways as a combined company to change the gaming business. And of course, you throw the metaverse in there, it kind of makes everything start flying. But let's make that specific. How would you value synergy in that merger? There's also an element of control in this acquisition, right? Because Activision has had a fairly interesting couple of years. And I'm using the word interesting again with a lot of pause, because they've had this issue of internal, they've not had good internal controls, all kinds of scandals. So maybe they need a new management team. That's value control. How do you value control? So we're going to talk about acquisitions and value control and synergy, without the hand waving that you often see in mergers. We're also going to talk about how you change the value of a company. For much of this class, I'm going to look at companies from the outside in. You know what I mean by the outside in? As an investor looking at Peloton, as an investor looking at Activision, an investor looking at Microsoft. But in this session, I'm going to open the door and you're going to go and say, if you ran Peloton, how would you increase the value of a company? It's a lot more fun. It's in fact what we did in corporate finance. I'm essentially looking at the same question through the lens of valuation. If you come into a company that's in trouble, what would you do to change the way the company runs? What kind of story would you need to tell for Peloton? How would you put that story into practice? That pretty much takes us through the end of the class. As I said, it's a class about valuation, valuing just about any kind of asset. Now, in terms of background, I won't spend too much time. There are 3 skills I think we need to bring to the table, not just in valuation, but in investing. One is you need to understand basic accounting, not in the sense of debit, credit. I frankly couldn't care less, but in terms of being able to read financial statements. The second is statistics. I'll tell you, after the last 2 years and seeing the kinds of things, it's not just in finance, but in our lives driven by people not understanding statistics, you almost have to rethink how we teach statistics in classes. Both sides, people are, you look at numbers, people are just making up numbers to justify actions. So statistics, again, I'm not talking about can you do a regression. Let's face it, we have the tools that do it, but can you read a regression? Can you read a correlation matrix? We should be able to do that. And finally, It's very difficult to do valuation if you don't know how present value works. So if you're still struggling with that PV button in your calculator, you need to win this fight. If to you PV is still that button, you have a problem, because you need to understand not just what's happening behind the surface, but also what the intuition is. You need to know when you get a number from your present value button, if it doesn't make sense, you should be able to say, hey, that doesn't make sense. The present value of $1,000 every year for the next 5 years cannot be $5,500. You know why, right? It's $1,000 every year for the next 5 years. The nominal value is 5,000. If you come up with the present value of 5,500, something very strange is going on with your inputs. If you're uncomfortable with your accounting, if you're uncomfortable with your statistics, if you're uncomfortable with your foundations, I could ask you to go back and complain to the professors who taught these classes, but what's the point of that? So I've created these short courses on my website that you're welcome to visit and take. They're about 12 sessions apiece. They're from my perspective on what accounting I think we need in investing. So it's a very personal perspective. An accounting purist, a statistics purist would probably blanch at some of these classes and what I've included or not included there. But they serve my purpose. If you want to take those as kind of a way of catching up, you're welcome to. And as with corporate finance, I'm going to take over your life for the next 15 weeks. So you know what's coming. I might as well flesh it out. So after class today, you're going to get an email. What will the email include? It'll include what we talked about in class today. You're saying, I was there. Fine. Just look at what you know, maybe you don't remember. Maybe you have selective amnesia. Maybe you were physically here, but mentally gone. It's the first day of class after all. So it'll be a review of what we did in class. And every class, I will send a post-class test for the class, just like in corporate finance. Basically, it's not a big deal. It'll take about 5 minutes. We can take the post-class and did I get the basic tenor of the class with solutions. Tuesday, as I said, you get the valuation of the week. So tomorrow, you're going to get the Tesla valuation. And every Tuesday after that, you get the valuation of the week. Completely optional. As I said, if you choose not to do it, I'm not going to come chasing you and ask you to do it. But essentially, the idea here is to get your hands dirty. Wednesday, after the class, in addition, with my regular email, I'll send out what I call a weekly challenge. What does a weekly challenge do? It takes what we learned that week in class and takes it to the next level. By next level, it's not going to be mechanical. Can you take what you learned in class, which is mechanical, and extend it conceptually if I came to you with the weekly? So the weekly challenge is about taking what you learned in class and saying, can I expand on it? On Thursday, I'm going to remind you of where you should be on your project. You're saying, what project? Talk about that in a minute, but each of you is going to be valuing a company over the next 15 weeks. My job is to keep nagging you each week to make sure you are, in fact, moving. And I'll be quite honest, most of you will ignore my nagging. You'll do everything in the last 2 weeks. Now, don't blame me when something goes wrong, but basically, think of it as a GPS you're ignoring. Okay. On Friday, I'll send out a webcast on something very practical. Like when we talk about risk-free rates, I'll talk about, hey, how exactly would you get a risk-free rate in Indonesian rupiah? So take an actual currency, work it through, so you can see where I get the data, how I adjust for things. On Saturday, I'll send out a newsletter that tells you what we did during the week. Don't expect much news. It's basically, again, telling you where we are in the lecture notes, where we're going, and perhaps a few links related to material for that week. On Sunday, I'll send you the solution to the weekly challenge. Again, the weekly challenge is completely optional. So if you choose to do it and you want to check to see what the solution looks like, you'll see it on Sunday. So that takes you through the entire week, which means every day for the rest of the semester, you can view this either as a threat or a promise. You get an email, but I will leave you alone during spring break. There will be a 7-day window where you can do whatever you want, but the rest of the semester, you're mine. Right? In terms of class material, every slide you're going to see in the class is in the lecture note packet. There are 3 lecture note packets. They've all been updated for spring of 2022. I used to put them in the bookstore for buying, but I'm not even going to try this semester because the lag between my sending material to the bookstore and it showing up is so long, it's not worth it. And why pay the premium to the bookstore? If you really want your files to be printed, just take it to a, say, you can do it online. You can get a printer to do it for you at a far lower cost. But if you want to just keep it digitally, I'm perfectly okay with it. Okay? But for some of you, you might want the physical paper. The one thing I would beg of you is don't use the printers in this building to print the packet. It's 800 pages, 800 times 200 is, the printers will break and then they'll blame me. Okay. So if you want to print one session because you forgot, that's fine, but don't do it all. There are no class, the only class rule is let me set the rules. So don't turn on people because they're asking too many questions. Let me handle making sure we get things done. Okay. So, whatever question you have, as I said, something doesn't make sense, you want to talk, let's not bring on tangents, right? So there's almost everything has something to do with value, but let's make it relevant to the topic of the day. So we're going to talk about risk premiums. It's not talking about dividend payout ratios or buybacks. There will be a time to bring that in. You don't need any books. There are no required books. If you do need a book, I have 5 different books on valuation, and I've actually on my website listed out what's different about each of them. Now, so there is my first book is very, tells you the hubris behind the name. It was called The Modern Valuation, the very first book I ever wrote. And I remember asking my publisher, can we call it O.J. Simpson and Valuation? Because this is during the O.J. Simpson trial. I said that'll increase sales a lot. Because people read who the heck is the modern? So that book is basically a book about, the first half of the book is about valuation. The second half is what I call the loose ends in valuation, things like control premiums, liquidity discounts. And I have investment valuation, which is really the only textbook out of the 5, since it has problems and solutions at the end of each chapter. My favorite valuation book, there are 2 books that I hold close to my heart. One is The Dark Side of Valuation, which is about valuing difficult to value companies, from young startups to distressed companies. And the other is Narrative and Numbers, about connecting stories to numbers. So that part of it is what appeals to you. But none of these books are needed. You'll be perfectly okay without any of these books. So don't feel any pressure to get the books. Incidentally, if you have an Apple device, an iPad or an iPhone, a friend of mine, Anand Sundaram at Dartmouth, and I have created this app called UValue. So if you get a chance, visit the Apple, and it's only for an Apple. So if you're an Android, you're on your own. And it's an intrinsic valuation app where you're stuck at an airport and you're a geek, rather than doing what most people are doing now, which is go to sleep because nothing else you can do. You sit there playing on your iPad trying to value Peloton. So with 12 inputs, so it's actually a pretty versatile app. It'll value young companies, old companies. So give it a shot when you get a chance. Because the reason we co-developed the app was to let people know that what people are doing is mechanical. We can do it for nothing because the app is free. Basically, give it a shot. It might be interesting, if nothing else. Now, in terms of staying connected, almost all of the material you need for the class will be on the web page for the class. Now, I know that there is an NYU Learning Brightspace. I'll be honest up front. I'm not even going to go there. Nothing is going to show up there. So don't go looking on Brightspace for things. There'll be some things that I can do only through Brightspace, but almost everything else will be through my website and the web page. There is every class, in addition to being live Zoomed, is going to be recorded. And the recording is going to be converted to YouTube video as well. So you can either download the file and watch it if you can't watch it live, or you can watch it on there's going to be a playlist of every lecture in the class. And finally, every email I send you will go into my email chronicles, just like in the corporate finance class, where you can see. So as we go through the class, that's going to get longer and longer. You can go back and check, for an email from 2 months ago, 6 weeks ago, 4 weeks ago. In terms of additional stuff, there is a Google Calendar. I sent you the link to the calendar. The most critical thing that I want you to check is the quiz dates, which are specified in the calendar. The final exam is still up in the air, so as soon as I know when it's going to be, I'll list it out. So quiz date, but it also gives you nagging reminders about where you should be on the project. Like you need to form a group, you need to pick a company, you need to estimate the cost of capital. So that's the Google Calendar for the class. Now, along the way, I will send you links to posts I have on my blog, because they're almost all about valuation of corporate finance. So if you looked at the emails I sent, most of you should have got my first 3 emails, right? You should have seen the links I sent to my first 3 posts for which I call my data update post. Last week, I had a post on inflation, something that's going to be front and center in this class because it's going to play out in markets, it's going to affect evaluations. So I will send you links when I have posts that might be useful to you. Now, and whenever I post new data or a new post, I also have a tweet about it. So you don't have to follow my Twitter, although I love the numbers. So if you have 3 emails, put them all in. Now they all add to my follower list so that I can tell people, look, I have 300,000 followers now. Not seriously, you don't have to be a Twitter follower. I'm thinking of creating a TikTok. That's the next phase. Is my kids don't even go on YouTube or Twitter anymore, but that's maybe for another day. For the unpleasant stuff, there will be a grade in the class. So this is not, and the distribution is kind of preset. Okay? But I'll tell you what I'm looking for on this grade. If you can value just about anything, I'm looking to give you an A or an A minus. If you can value most things, well, that's pretty good. B, B plus. If you can value something, that's not asking for much, it's C or C minus. If you can value nothing by the end of this class, I don't think you really deserve an A, B, or C. So it's my job to figure out how to gauge what you can value. But that's what the end game for the valuation quizzes is, the exam and the project is to see if you can really value businesses, because that's really what I want you to take out of this class. Now, in terms of the project, it's a project, as I said, it's about valuing a company and you take it through the entire semester. I will do something that I did not do in my corporate finance class. One of the problems with teaching this class to second-year MBAs, and many of you are second-year MBAs who plan to graduate in May, is you have this phenomenon called premature graduation. You know what that is? Around March, you've already in your mind graduated, which means it's very difficult to get you to work in April or May. So to kind of offset it, what I'm going to do is ask you to do your intrinsic valuation, which is the heart of the project, and get it to me by April 1st, not for a grade, but for feedback. Again, completely optional. If you say, look, I'm completely in control of this, I can do it all on the last day, that's fine. But if you want me to give you feedback on maybe you want to tweak this growth rate, maybe this, this currency match doesn't work. If you can get me your DCF by April 1st, I'll get it back to you within 2 or 3 days and what the tweaking might be. The final project report is due on May 9th, the last day of class, by 5 p.m. The quizzes and the exam, there are 3 quizzes, March 2nd, April 4th, and April 25th. But each of the quizzes is worth 10%. They're all open book, open notes. Okay? And I think we should be able to all fit into this room. There's enough space. We can spread it out. So there's at least 1 seat between people. If you have to miss a quiz, it's not the end of the world. All I will do is take that 10% and move it to what's left in the class. It's always so I can't move it backwards because that would give you strategic reasons for missing quizzes, always forward. So 3 quizzes, 10% apiece, a final exam, which will be in the last finals week. At the moment, I'm planning to do all the quizzes in person. But given how this virus has played havoc with our lives, who knows what 3 weeks from now will look like, 5 weeks from now will look like. And if you cannot physically be in class because you have health reasons, then we'll figure something out. But those of you who don't have that constraint, plan on the quizzes and final exam being in class. Because I'll be quite honest, I don't like online exams because they tend to be multiple choice. And you remember, we did this in corporate finance. This way I can ask you questions which are not multiple choice. I can see your work and give you partial credit. And I feel much more comfortable because it gives me a better gauge whether you truly understand the stuff. So those are the quiz rules. You can read them. They're very similar to the corporate finance quiz rules. So it's open book, open notes, no laptops. And it's 30 minutes, the first 30 minutes on those days, and there'll be class after the quiz. So kind of plan on having a class after the quiz, 3 short quizzes, 1 final exam. Any questions on the logistics, or very quickly on the project, because I'm going to end with that. Yeah. I'm not going to spend too much time on the project, but as I said, here's your nag item for this week on the project. Yes, go ahead.
For the quizzes, if it's no laptop, so we don't have a hard copy of the notes, do we use like
Oh, you can bring your iPad. I mean, the honor code applies. Obviously, with an iPad Pro, you can have Excel there, and I won't be able to tell. But I mean, I will assume that if you have your iPad open, it's to check the notes. So I'm not going to be, too finicky about those things, because it's digital. You got to figure it out somewhere. The honor code applies. So clearly, if you use your iPad, use it for the notes. You can even use it as a calculator, but you cannot use it in Excel mode. So it's kind of a line that I have to draw somewhere, because the kind of quiz I would give you, if you're able to bring a laptop, is not the kind of quiz you want to see, to be quite honest. So this is a better option, I would suggest, than the kind of quiz you would get with a full laptop. In terms of the project, here's the task for this week. I want you to find a group and join it, or create your own group. I know some of you will have trouble finding a group, either because you're new to the class, maybe you're a Langone student, or you're an exchange student. I've created, just like in corporate finance, an orphan group, and I'll send out the Google shared spreadsheet for the orphan group, which means if you cannot find a group, put your names on that list. And there are 2 strategies you can adopt if you're on the orphan list. One is, if there are enough orphans, you can create your own orphan group, kind of a pathetic phenomenon, but 5 people, nobody wants you. You can come together as a group of nobody wants us. Or people who have groups of 3 or 4 want a 5th person, can pick you out of the orphan list. One final thing is, when you pick a company, I'm going to impose a constraint that's group-wide. At least one of your companies has to be a money-losing company, which shouldn't be any trouble in today's market. Right? You pick an airline, money-losing company. You pick a young company, money-losing company. But at least one company needs to be a money-losing company. At least one company has to have high growth in revenue terms. At least one company has to be a non-US company, preferably with a valuation in local currency terms. So I'm willing to make an exception if you're valuing a company like Alibaba, which is a Chinese company, but it's listed in the US and all its financials are in dollars. And one company is a service company. I should remove that constraint, because pretty much 80% of the companies out there are service companies, software companies. So basically, ignore the service part, but you have to have at least one money loser, one growth company, one foreign company. Obviously, you can kill all 3 birds with 1 stone, right? If you value Didi, you got all 3 nailed down. Chinese company, money loser, revenue growth. And of course, that might be a strategy used to punish one person in your group, saying, you do Didi, and then we'll do whatever we want. Now, but I'll let you work out the bargaining power you get by being 4 members and getting a 5th member that you can load off all of these on. But what you're going to be doing with this company is essentially valuing the company through the semester. That's about it. I will see you on Wednesday.